Hi guys, welcome back to the channel. If you could like and subscribe, that would be great. That would really help me out. So today I'm going to continue on a video that I had made earlier. This is regarding the option yield ETFs. Last time I talked more about Yieldmax, but today I'm going to talk more about like the Defiance set of ETFs. So like as you know, like the TradFi markets are still kind of wobbly and I think a lot of people are just looking for better yields. Um, so I think these option based ETFs, it could be a good part of your overall portfolio. So I started trial positions in several yield max and Defiance ETFs, and today I'm going to talk more about the triple QY, just because it happens to have like like options on the triple QY itself. So it's pretty unique, I think. But first, just to go over how the triple QY makes their money. So it's similar to Yieldmax in that they have a good chunk of their money in cash and treasuries, and then they use option strategies to generate the yield that they pass on to us through options. But instead of doing covered calls, they're doing cash secured puts, and they try to get about 25 basis points per trade or per day, I should say. And I think that's pretty unique. But in in all reality, it's very similar to a covered call. Like if you study like Finance 101, a covered call is basically has the same risk return profile as a cash secured put. Um, and on the fine print, you can actually read on the website how they actually attempt to do this. And I'll give you guys examples through both the NDX and the triple Q ETF. And I think these are pretty good in that they're professionally managed. Like two of the managers here, they're CFA charter holders, and these are not easy exams because you need to pass three parts, and then you also need a relevant job experience to get this designation. So I think we should be in good hands. But again, it's always good to have like a backup plan in case I guess like at some point your your portfolio is gonna get to a big size. And instead of paying like someone else, like you could probably do it yourself once you get to that size. But I think this is a good start for most people. So you can go to the website at Defiance ETFs, and this is the triple QY. And they actually show you like how they're doing it. So they're pretty transparent. Um, so again, as I mentioned, they use treasury as collateral. Uh, so both as a yield um, uh, kind of like instrument, and then also the what they try to do is try to get 25 basis points um, on the cash secured puts on the NDX. But most retail investors they can use the triple Qs as a proxy for smaller accounts. So if you want to try to replicate this yourself, you can. And then this is just to show you the triple QY. So pretty soon, uh, like right now they're NAs, but this is a good sign that they're going to start having options on the triple QY itself, similar to how I believe NVDY and TSLY also have like options. So you can also kind of do what they call a wheel strategy. You can sell a cash secured put on like this ETF to start a position, and if you don't get assigned, you keep the premium, and then you keep doing it until you get assigned on the put, and then once you do get assigned, you can then sell covered calls against it until it get assigned again. So you keep the cycle of the trade going infinitely. Um, but I think like if you get assigned on the triple QY itself, it's not a bad thing. Um, I think because like the whole purpose is to try to uh, get the yield, and you don't have to do a lot of the work yourself. But I'm just gonna show you how like a retail investor could try to replicate something similar to the returns, because the past return I think was pretty good, um, depending on your cost basis. Uh, they're on track to get between like 50 and 60% per annum, and they do pay out monthly, so that's a good thing. Uh, but just in case, if you have a pretty large account and you want to try to do this yourself, um, since they're targeting 25 basis points, you want to multiply this by the cost of the ETF itself. So right now, it's $364.70 at the time of this recording, per share of triple QY. So then you just multiply that by 100, because each option contract is 100 shares. And then just to get an approximation of what you want to try to target, since the fund itself tries to get 25 basis points, you multiply that 0.0025 times the cost of the triple Q position, and that gives you about $91.18. So that gives you kind of like a target number that you want to try to get in terms of premium per day. So if you look through the option chain, like the different strikes, so the closest thing, depending on if you're um, conservative, how conservative you want to be, you can get the 364 strike, if you want to give yourself a little bit of wiggle room. But let's just take, for example, the 365 strike. That's $153. At the worst case, if you just sell at the bid, and you don't want to work the order to get maybe like a little bit better to $1.54. Um, but again, this is just an example. So the 365 strike would be good enough. It's uh, you're close enough to to being at the money, or even in the money. So let's just say, for example, you collect $153 per trading day, so there's roughly 250 trading days, and that gives you about like $38,000 and 250. Um, but of course, 105% return a year isn't realistic for most people. Um, and say like the managers, if they can pull this off at even just half, so you have to obviously account for losses, and then there's just going to be days when the market just like tanks, like maybe there's another war coming, or supply chain disruptions and whatnot. So even if they can, if the managers can pull off like you know in the 50% range, that would still be amazing. That, I mean, there's not that many, like even hedge funds that can do that. So let's just say, for the sake of argument, you do get assigned, uh, because like the market just like tanks. You would be assigned, because like it's the 365 strike, so I have to multiply that by 100. So you have to have $36,000 and $500 to cover the cost of the assignment. Um, and then what happens is you can also like sell a covered call, until you get assigned again. Um, because let's say the like on a daily basis, if like even if the market drops like something serious, like 1 or 2%, um, you could still eventually make that up if you sell enough covered calls. So for example, if you do get a side at 365, you can then sell this 365 covered call. And then in this example, of course, like prices can change, but let's just say, like, again, you sell at 172, like if you're selling at the bid, that $172 that you collect from the call side, that will help to offset your cost basis. And then you can always like move down like um the call strikes. So then, like, a week later you might be able to sell further in the money. But of course, like, it depends on how the market changes. So that's always up to your discretion how aggressive you want to be. Like if you're just looking for like the premiums from like the option selling, you know, if you're the closer to at the money that you get, the more premium is going to be available to you. So and then now I'm going to go to the NDX options. So these are cash settled, so there's no risk of assignment. So if the market goes against you, you just have to pay up in cash rather than getting assigned any stocks. So there's one less worry, but again, you can still lose money. So just to put that out there. So again, let's just take 25 basis points times the NDX at the time of this recording was 14,973. So you have to multiply that by 100. So you have to have close to $1.5 million available. Um, well, technically you don't have to have that because it's cash settled. But I'll explain using more with this example. So that 1,000,005 times 25 basis points. That's just to calculate the like the premium that you would like to collect. So so we're looking for 37.43. So right around like the 14,925. If that's good enough, you could just sell that. But if you're feeling confident, if you go all the way up to like the 14,970, you can collect actually quite a bit more at $5,300, and that's at the worst price. And if you notice, like the bid and ask for the NDX is a lot bigger. So you, if you want to try this on your own, um, I would suggest being really careful and just um, doing one contract. Um, because like even though it looks like they're juicy premiums, you have a lot of risk at hand, especially if the market takes a nosedive. But going back to this example, let's just say you take you're able to do this consistently. You, that it would be a pretty ridiculous amount per year. You would collect about 1.3 million, um, and you will get an 88% return a year. Again, this is not realistic. And even if the managers can pull off half at 44%, that still would be amazing. Like I don't think too many people are going to complain about like 44% a yield a year. That would be amazing if they can pull this off. But so far they're on a pretty good track. Um, but hopefully they'll continue doing that. And again, you for the NDX especially, you probably need to use margin, but I don't recommend it. Um, Especially if you have a smaller account. Don't you're probably better off just using triple Q because even just looking back at the triple Q, um, like having $36,000 around just to do one contract is a lot. So I think for most folks, um, the ETF is a real bargain. And I know that 1% annual expense is quite a bit, but in return we are getting a pretty good yield out of this. So everybody has to weigh the risks and rewards and kind of make their own decision. Because obviously none of this is financial advice. Um, I would say there's a lot of pros for, especially if you have a smaller account balance. It's pretty easy. You just buy it, and you just wait for the dividends to come in like every month. Um, and then this saves money on fees for small accounts, and there's more transparency because, like I said earlier, they actually show you like the strikes that they're using per day every day. So it's pretty cool to see this level of transparency. Um, and then like the risk is like it is pretty high expense ratio, but we are getting uh, some good active managers. Um, so that you have to kind of balance it out whether it's worth it to you or not. And then like if you're just buying the ETF itself, the triple QY, you don't have any control over your option strike selection. But for those that want more control, like you can just follow some of the examples that I showed earlier with the triple Q ETF and the NDX index options. Because like that, not the implied volatility won't be might not be as high as this particular month, like especially the market rallies. Like implied volatility tends to go down. Um, so so something to keep in mind. And sometimes I do have problems with buying buying some of the ETFs on Tasty Trade. Most of the time they're pretty good, but there are some days where for some reason I can't enter an order. And that's why I've started putting in like the Moomoo affiliate link. Um, because they're pretty so far so good. Occasionally they do give you like free stocks. So just check it out for yourself. If you don't want to, that's fine. Either way, you can use any brokerage you want. There's no requirements here. And then you also have to keep in mind like obviously the yields are going to change from month to month. So so that's why don't just get rid of like whatever you have in your current portfolio. If they're still working for you, that's great. Because these ETFs are still pretty new. But so far so good. I have high hopes for these ETFs because I think this bringing both like some excitement and more importantly like actual cash flows back into investors' pockets. So in a future video, like really looking forward to showing like how the options work on like the options ETF itself. So it's pretty wild. But these are I think we're living in good times, exciting times. So thank you for watching. If you could again consider liking and subscribing to the channel, that would really help me out. So thank you and have a great one.